I'm JB Bryan, the President and Chief Investment Officer at JB Bryan Financial Group, a registered investment advisory firm and the home of AfroEconomics. And AfroEconomics has membership. And a big part of our membership is entrepreneurs. We have our entrepreneur membership. Check it out at AfroEconomics.com. And that brought about the Let's Talk Business because I realized that there's so many entrepreneurs like myself who are out there alone, and I don't want that to happen to anyone else. 20 years ago, well, more than 20 years ago, in 1995, when I started my business, I did not have anyone to talk to. So I want to make sure that I use my days here on earth to make it easier for those who come behind me. That's what AfroEconomics is. Principle one, legacy. And for everyone who has their own business, I know you know that that the pain and the joys that we have, a lot of it can be carried on to our next generation if we do this properly. Our business does not have to end with our lives. This should be the beginning, like with investing. You know, that when you first invest and then the longer you have it invested in a good investment, your returns start compounding. Well, let's make sure that our businesses do the same. And that's why we have Let's Talk Business each Sunday. I have the AfroEconomics membership for you to take advantage of. So today is about business loans. Are they the answer? I think that that is probably the biggest question that you see when people say, I want to start a business, but I'm trying to get a loan. That every time I hear them say that as the beginning of their business, then it frightens me because I know that thinking that you're going to get a lender to approve a banking loan based on a new business just isn't going to happen. So we have to, think about it that you need to understand them because there will come a time where you are being actually approached by financial institutions to do loans with them. Every day my fax machine gets a fax on some financial entity trying to get me to finance something with them. So today I want to make sure that we catalog this and you remember this. Share this on your page right now if you have friends that have their own business, that we just need to understand the value of loans and when to use them and when not to use them. And do they really have value? Are they the key to our success? I don't believe so. I believe it's our effort in learning the proper use of finances can be. If your business is financial intensive, like you need to buy trucks, you need to buy vehicles, you need to buy inventory, then you definitely need to listen in on this. And so, and there's always businesses that don't need to buy the equipment and buildings and things like that, but they also need to have just some working capital to make sure that you can cover payroll and things like that. Well, here's the idea, because I honestly have always been like, avoid debt by any means necessary. Well, yeah, on a personal level, that is true. But on a business level, we have to be careful because sometimes it is the best thing that you can do is to get a financial institution to assist you in getting some money up front so that you can hire the people that you need to fulfill a contract that you may have received. So if you're a contractor, definitely listen up also. So let's talk about the 3 most popular business loan types. I feel are the credit line, a line of credit loan, an installment loan, and the balloon loan. And they can be either secured or unsecured. So when we're talking about the line of credit loans, I'm going to give you the real. I'm gonna give you the real. I'm just gonna read so that you don't get like my summary of what it is. I want to read something written so that you really get what it means. And if you have to repeat it 3 times, then you do that. A line of credit is a short-term loan that extends the cash available in your business's checking account to the upper limit of the loan that you've taken out using that credit line. And so a credit line is indeed a loan. and it's attached to your checking account. Every bank has its own method of funding them, which means like there's some banks that will say that your credit line has to be on zero for at least 30 days out of a year for you to keep the line, you know, or at least for 1 week. Or it might say it just needs to be paid off at least one day of each year. And I tell you, that day or that month that you have it paid off, that's the time where you approach the bank and say, look, it's paid off, and get it increased for other future needs. So a credit line is not a debt that you should expect to use for having for a long period of time. It's just to front you for a contract, or you're waiting for a particular payment to come in, and then you may use that. So every bank has its own method of funding. Essentially, it's an amount, whatever the amount is that you're approved for, is transferred to your business checking account to cover the checks that you would write or the expenses that you would write in order to cover the things that the credit. So the credit line is just extending your checking account. Your business pays interest on the actual amount that is advanced from the time it is advanced to you until you pay it. So that's your line of credit. Now, you might have a line of credit where, remember I said they're either secured or unsecured. So they might say that we'll extend you $10,000, but we need to have $5,000 as a secured against it, or we need to have the car that you own might act as collateral, which is being secured. When they say you need to have collateral, that's a secured loan. Unsecured would mean they didn't ask for any assets or any money from you in order for them to lend it to you. So, of course, when something is unsecured, then they're saying, like, then I'm going to again rely on my written notes to make sure that I say it correctly. Unsecured loan is when the bank considers you to be a low risk. So when you're a new business, it's highly unlikely that you will be approved for or qualified for an unsecured loan. It generally requires a track record in order to have a loan that's not secured on some sort of asset. So remember that. And then the second most popular type is the installment loan. So the installment loans are the loans that you pay back on equal monthly payments, right? They're covering both the principal and the interest with those payments. And the installment loans may be written to meet all of your business needs. So you receive the full amount when the contract is signed, and the interest is calculated from that date to the final date of the loan. And if you repay your installment loan before its final date, there is no penalty. That's right. So the installment loan is like a mortgage loan or a car loan, you know, where you have a particular amount that is due, a specific amount that is due all the time, where that credit line, your payment would be based on how much you've used of your credit line. And of course, the installment loan would not have to have a zero balance or wouldn't have those different criteria. And then the lines of credit are adjustable interest rates, so they can be changed. You have to find out, like, how often can my interest rate on my credit line change? They might say every day, they might say once a month, they might say every 3 months, but it's going to be an adjustable rate on that credit line. Versus an installment loan, you know forever, the entire period of that loan, that is the interest rate that you have. And then you have balloon loans. Now, these loans are generally written to use for, and you have collateral generally on a balloon loan. They'll be attached to collateral. You might use it for, like, say, a commercial property. I've used a balloon loan before to purchase commercial property, and then they might say that they're lending you this money for 5 years, but at the end of the 5 years, you have to refinance or, you know, sell the property or whatever your choice is to do. And so what you could do is you're really hoping for that at the end of the 5 years, your property value has increased, and that, or you've made a decision you don't want it anymore, so you're selling it, but you got to sell it before the loan balloons, meaning it's all due at a particular time. Now, a 1-year balloon, that would be scary. A 2-year balloon, that's scary. 5-year balloon, a little bit more manageable because you can really see what you want to do. If you want to keep the property, or you want to, or you want whatever you want to do with the property. You have a lot more time, because even if you had to sell it, you have like 2 years in order to sell that particular property that might be attached to a balloon loan, but the interest rate would be fixed for that particular period of time. And then it says that a lender is offering a loan with both interest and principal are paid with a single balloon payment. Balloon loans are usually reserved for situations when a business has to wait until a specific date before receiving a payment from a client, or for a product, or for services. So if they have some particular date in mind, and they're going to at the end of this contract, or this contract is coming due, or this contract lasts for 5 years. That's typically what you're going to see. They're saying, we'll give you this loan, but only for this particular time that you have this contract that we know is guaranteed. So based on you having that contract, 5-year contract, or that 2-year contract, then we will give you this loan. But after that, you're going to have to come back and show us that we want to extend, the loan to you for more. So, and then again, it can be secured or unsecured. So the secured loan, and I talked about the unsecured, is that when the unsecured is when you don't have any collateral on it. So if you're doing a business loan to buy a bulldozer, then that is a secured loan, because they can come and take the bulldozer if you don't make the payment. So that's a secured loan. An unsecured loan is when they've just given you the money, and it's not based on anything but your ability to pay it back. So a secured loan requires some kind of collateral, but generally has a lower interest rate than an unsecured loan, because what? They are guaranteed to make some money back because they have that asset attached to it. When a loan is written for more than 12 months, or is used to purchase equipment, or does not seem risk-free, the lender will ask that the loan be secured by collateral. So, and that could be because you're a newer business, or the income is inconsistent, or the credit is not strong. But definitely that there's the secured in having the assets available for them to the bank, having access. They might even like say a car loan. A basic car loan is a secured loan. That's a good example. It's an installment loan that is secured by that vehicle. So then let's just talk about just some general types. Like a lot of times we hear, I had on here, I want to talk about other types of popular loans that business owners ask about. Second mortgages on their home. A lot of business owners that have a property, the lender might ask you to put a second mortgage on your home and that's basically, they're asking you to secure the loan with the equity that's in your house. Do we have to be careful when you do that? But that's what they want. On a lot of the government Small Business Administration loans, they're not going to lend it to you unless they have the security of your primary, not investment property, your primary residence. So we have to be conscious of that you have to, that when you attach some collateral to it, and many government loans also require that they have a life insurance policy on you, that upon your death, they're going to make sure, because a Small Business Administration has the bank is going to the government and asking them, will they guarantee this loan for the bank? So the money is actually coming from the bank, but the government is just guaranteeing to the bank that we'll cover them if we have to. So they make sure that they can be covered. So be very careful what you do to collateralize a loan, especially when it's connected to, your business. You have to, make sure that you're protecting your personal interests at the same time. So be very careful on, do you need this loan? Do I have to secure it with these things? Is there other ways around it? And that's the challenge as a Black business owner. It really is, because many businesses are started with family members putting in money. So if your family members cannot give you the money that you need and you want to start a construction company, then you're left with the bank or doing some things called like private placements. And one of these discussions I want to talk to you about on a Sunday, we're going to talk about alternative investment or alternative loan sources. And for the investor, it's considered an alternative investment when they're investing in a business idea, or private placement, or how small businesses, small corporations can actually sell shares of your business to private investors as an alternative to bank loans when you feel like you can't have any success at the bank, especially if you're coming out with a new idea. If you look at the story behind Apple Computer, he had to go to a private investor and they did a private placement. And he had to give up some of the ownership of his company in order to buy what was needed for their first contract, because computers just don't fall out of the sky. And they had to build these things. He had to pay people, and he had to buy the equipment and the things that go into the computer. So they had to find a private investor, because the banks were like, I don't know what you're talking about. No. Thanks for coming in. See you later. So those are the challenges that we repeatedly are faced with. So we have to continue to be determined, the ninth principle of AfroEconomics, and we have to make a commitment to building our business and looking at all of the sources, and most importantly, protecting your credit. So that's why making sure that we live within our means on a personal level, because when it comes down to it, when you're a small business, they're going to ask you at some point to guarantee that this loan you're considering does get paid back. So it will be connected to you as the business owner at some point, most likely, 99% of the time. They're not going to walk away without you being the guarantee on it as a small Black business owner. But definitely, let's talk more about this. Make sure that if you're considering getting a loan, you gotta have your financial statements in order, gotta have your financial plan together, gotta have your credit protected. All of these are principles of AfroEconomics. Please check them out. Check out the book in the bookstore. Make sure that you take advantage of it. Get the information on the November 5th workshop. The November 5th workshop for business owners. It's all about you. It's already on AfroEconomics.com. Go to events, get the information on the events. Go ahead and register, get the hotel information. You can do this. You have a wonderful week. This is the beginning of the week. This is it. So let's make it happen. Thank God for another beautiful Sunday. I thank you for your time. Please reach out to me, jb@afroeconomics.com, inbox, email, go to the website, click chat. It's so easy to get empowered. Allow me to assist you. Have a wonderful day. God bless y'all.